Well, part of those concerns about the Fed has to do with inflation. Oil, a part of that story. For more, we're joined this morning from London by Bloomberg Best Macquarie Capital Europe analyst Jason Gammel on the oil markets. And, you know, we've seen oil prices sort of stay around this 30-month high. What's kept it up there? Is it just strictly Middle East tensions or what?
Well, I think it's more than tensions, Betty. We've actually removed quite a bit of oil from the market, particularly in the case of Libya. And we've also seen striking conditions in Gabon and some political problems in Yemen take oil off the market. So I really think it's just that it's been the severe snap that the market has seen that has tightened things up. And, you know, it's been too early for demand to react. So we view this as very much a tight fundamental market.
So you forecast a continued supply shortfall then, Jason?
I think it's going to be tough for the supply side to respond to what is still pretty strong demand. Now, certainly rising Chinese interest rates and the absolute pricing level itself having some effect on GDP in the OECD in particular is going to help to alleviate things. But it's not going to be fast enough, I think, to cause a severe drop in prices at this point.
But, you know, Jason, we've heard time and again from the Saudi officials that they do have enough production that they're able to meet any sort of offset in production or disruptions that you've seen in Libya or elsewhere. Why aren't the oil markets buying that, though?
Well, the Saudis have begun to respond. I think that the problem is the Saudis have responded to a point where they're beginning to test the highest levels of production that we've seen from them in the last 10 years. And I think the market's become nervous that the incremental spare capacity that may be setting still offline may not be able to respond in time. Whenever you see spare capacity drop to 1 to 3% of demand, which is where we're at right now, the markets generally price in a scarcity premium.
I see. Okay, so it may not be in time or it may not be enough. Jason, then, should OPEC meet before their regular meeting in June? Should there be an emergency meeting?
From a cosmetic standpoint, it may help, but for all intents and purposes, the Saudi Arabia is really the only one with spare capacity. Saudi is the only one that's going to be able to respond in any meaningful way. So I think it's really going to be Saudi actions and Saudi statements that are really going to be important here.
If you took out, Jason, if you took out what is going on in the Middle East, would you see oil, let's say, $20, $30 lower?
Well, I think if we look at the movements in Brent since the Libyan incident occurred, that would be about the level that you'd get to. However, moving into the second quarter, that's a seasonally strong time for oil demand as refiners start to build up gasoline inventories, for instance. So we were actually expecting to see in the second quarter crude prices rise into the mid-hundreds anyway. So let's call it a $10 premium at this point versus what we would have expected just based upon fundamental conditions.
Okay, because what I'm trying to get at is if you took out, let's say, if you took out what is going on right now in Libya and the Middle East and North Africa, if you took that out, A, where would the oil price be? And B, what would be the biggest factor then for oil?
Well, I still think it would be that Brent prices would be around $105 to $110, and that the Saudis would be able to respond to that were it not for the loss of production in Libya, so that you may see Brent oil prices move back below 100 in the back half of the year. Okay. But we see extreme tightness in this market over the next 3 years. We were expecting to see $115 Brent oil prices in 2012 and 2013 from pure supply and demand considerations.
Okay, so it would be demand and supply. Central banks, are they any factor in oil right now?
I suppose on the margin, the weakness in the dollar has played a role in the move up in oil prices. There's a lot of extraneous factors that can come into play here. But we really think it's the lack of capital spending over the last 5 years and the major growth in non-OECD economies that are the primary factors moving oil prices here.
Jason, thank you. Appreciate it. You joining us. Jason Gammel with Macquarie, the Bloomberg Best Energy Analyst.